Hello, everyone. Thank you for joining us today as we discuss US taxes and investing considerations for Americans abroad in 2026. Before we dive in, a brief disclaimer. Please note that the webinar is for informational purposes only. It is not intended to offer advice or guidance on legal, tax, or investment matters. Such advice can only be given with a full understanding of each individual's specific situation. That being done, let's meet our panel. Tom Zachystal is founder and chief investment officer at International Asset Management, a US registered investment advisor specializing in discretionary investment management for Americans living abroad. Tom has an MBA in global management from Thunderbird University in Glendale, Arizona, and holds the Chartered Financial Analyst (CFA) credential and is a certified financial planner (CFP) practitioner. Tom lives in the San Francisco area, having previously lived overseas in several different countries. He's been providing investment advisory service to American expats for over 20 years. Nathalie Goldstein is an EA and co-founder of MyExpatTaxes. With a decade of experience helping Americans file their US taxes from abroad, Nathalie is a regular speaker on US expat taxes and regularly contributes to national US media. Originally from California, Nathalie resides in Vienna, Austria, so she brings a personal insight of the challenges of living abroad to every expat situation. So, without further ado, over to you, Tom.
All right, thanks, Hugo. Let me just get my screen share going here. Okay, hopefully that's working all right. So yeah, there's a little bit about me. I'm usually based in the San Francisco area. Although at the moment I'm in the mountains in a place called Bear Valley, so thankfully we have Starlink. And a little bit about the firm. So I started International Asset Management in 2002. I was an expat myself. I worked as an engineer in the oil business for a company called Schlumberger in about a dozen countries before that, and started International Asset Management, and we are what's called a registered investment advisor in the U.S. And what we do is we specialize in investment management and financial planning services for Americans living abroad. 90% of our clients are U.S. expats. That's pretty rare these days. Not a lot of American firms want to deal with non-U.S. residents anymore. We have clients in about 30 countries. About half our clients are in Europe, and about 3 years ago, we also started a business that's based out of Spain, which holds our European license. Another thing that's kind of unique is that we have both a U.S. and a European license, and clients all over the world. And so let's have a look at what we're going to talk about a little bit. So the theme is on our side, we're going to be talking about the investment management side of things. We're going to look at what happened in 2025 and try to get an opinion, a viewpoint on what might happen in 2026. But first of all, keeping things in perspective, because a lot has been going on politically, economically over the last year or so, and so we'll have a look at that. And another theme that comes up a lot amongst our clients is, what about the US dollar? It's been weakening a bit. If I live in Europe or somewhere else, maybe that's not so good for me if I'm spending my money in another currency. And I've got a little secret to share with you. It's not really a secret, but I call it a secret. So stay tuned for that. It has to do with the US dollar and currency fluctuations. And we'll have a look at what people are saying, investment analysts, and what our expectations are for the markets going forward over the next year, and along that, how to get some income from your portfolio, especially if you're retired. That might be nice. And also, income helps dampen the stock side of the portfolio, so you get some diversification that way. And then some specific U.S. expat issues that we see come up. So let's start with something that has been in the news a lot, which is interest rates. And these are U.S. interest rates, what we call the Fed funds rate, the interest rates that are set by the Federal Reserve. And as we can see, we're looking at a time span that goes back to about 2007. And so the Fed tends to raise interest rates in an inflationary environment, and then lower interest rates when we're in a recession or when the economy needs to be stimulated. And there's a lot of talk now about how the Trump administration would like to see lower interest rates. But the Federal Reserve has a dual mandate. They have to worry about inflation. They also have to worry about keeping people employed, and that's a tough juggling act to do. But to me, I think they're doing a great job. And so where are we on that? What direction might these rates go? And as you can see by this graph, we're kind of at the upper end of this graph, but this graph only goes back to 2007. If we look at a longer term graph, we actually see, and this goes back to the 70s, we actually see that we're kind of about the middle of the road on the Fed funds rate. And so could go up, could go down. I think we're kind of in a good spot here right now. Employment is pretty good in the States. Inflation has come down, it went up a lot with the Russia-Ukraine thing and so on. But inflation has come down. But still, it's kind of a K-shaped economy in the U.S. The rich keep getting richer, the poor keep getting poorer. And so I'm thinking that interest rates are probably going to stay more or less the same in the U.S., also probably in Europe. Interest rates are a lot lower in Europe. So I don't think that's going to be a big influence. I don't think we can really make some investment bets on interest rate directions over the next year. And the other thing we should mention is when interest rates go down, that tends to be negative for the currency. So if interest rates are going down in the US, that tends to be negative for the US dollar because investor money flows to higher yielding assets, which would be other currencies. So what have we seen in the US dollar recently? Well, definitely in 2025, we've seen a weakening trend. There's a lot of lines on here, but basically these are all US dollar exchange rates with the euro, the pound, up means the dollar is strengthening and down means the dollar is weakening. And as you can see, the dollar was weakening against most currencies except for the yen, sort of towards in the latter half of the year, which is the orange line. And then the Indian rupee, which is the green line, and the dollar has been strengthening versus the rupee for many years, in fact. So that trend has continued. But against most of the major currencies, the dollar weakened last year. It weakened over 10%, almost 12% against the euro last year, and 7% versus the pound. And the Mexican peso, it even weakened about 15%, 14% versus the peso. And that trend has continued. It's continued so far this year. This is a year-to-date graph. You can see the same kind of trend. The dollar is again weakened against the Indian rupee a bit, or strengthened against the Indian rupee a bit, but otherwise weakened against everything else. But what does that actually mean and what can we expect? So here's a US dollar versus the euro over the last 50 years. And what we can see is that the exchange rate is actually about in the middle of that trend. I mean, there are some outliers like in 1985 when, the dollar strengthened a lot and in a few places where the euro strengthened, but basically we're in the middle of that trend. And so it isn't correct to say that the dollar is especially weak or especially strong. We're kind of in the middle. I think it could go either way. I think we might see a bit more US dollar weakening this year, probably not as much as last year. And I say that just because, Trump wants to have a weaker dollar policy and possibly if the economy slows down a bit, then the Fed might have some room to lower interest rates. So we might see, I would say the trend is more in the downward direction for the dollar than upward right now, but probably not as much as last year. But here's where we get to that secret I was telling you about. A lot of people say, well, if I'm spending my money in the currency, shouldn't I be converting everything to euros or pounds or whatever I'm spending in if in fact I expect the dollar to weaken? But have a look at what happens when stock markets go down. And so this is the 2008 financial crisis. This chart is from the beginning of, or say mid-2007 to the end of 2009. So we're talking about the 2008 financial crisis. The blue line is the S&P 500 index. You can see it went down, at one point it was down over 50% at the beginning of 2009. And the orange line is the U.S. dollar versus the British pound exchange rate, and the purple line is the euro exchange rate. And you can clearly see that the dollar strengthens when investment markets go down. And this isn't just during the financial crisis of 2008. Here's the COVID crisis of 2029. There was a big sell-off when COVID got into the news and the world started shutting down. So this is you can see that sell-off in March of 2020 there, where the S&P 500 plummeted about 30% in about a month, and then it recovered again. And you can see the spikes in the US dollar as the dollar strengthened. And if we go back to the stock sell-off, 2022 was a down year in investment markets. And at one point, the S&P 500 was down 25% because mostly the technology companies sold off. And you can again see in 2022 how the dollar strengthened when the stock market was weakening. And this is just a great trend to be aware of, because what that means is if you're translating your investment account into euros and your account is maybe going down because the stock market's going down, but the dollar is strengthening at the same time, then in euros, you're getting sort of an offset. You're getting some great diversification. And so this is something to bear in mind, that it isn't necessarily better to have all your money in your local currency, because you do get this diversification benefit from holding US dollars. And in fact, if we look at this chart of 2022, at one point versus the euro, the dollar was up 15% when the market was down 25%. So in euros, you'd be down only about 10% in that case. So that's something that's very important to bear in mind when we're talking about currency diversification or not. And so what's been going on in stock markets? Well, last year was a pretty good year. I mean, it was a good year everywhere, but it was especially a good year outside the US. So there's a lot of lines here. Again, the pale blue line at the bottom is the S&P 500 index, and that was up 13%. You can see in April, that was Liberation Day, the beginning of April, where Trump announced all his tariffs, and so there's a divot there where stock markets plummeted, but they went back up. But what's clear here is that non-US markets are doing much better than US markets, or at least they did last year. And part of that is the currency effect because the dollar weakened as well. But a lot of it is just these markets are doing much better. And that's kind of interesting, because you would think, well, there's all these tariffs on all these other countries, but the stock markets of those countries are doing better than the US market. So, for example, the top performing one in this chart is the South African market, and mostly that has to do with mining companies doing pretty well. They have a lot of mining companies in South Africa, and then the one below that is Mexico, and then Brazil. So the emerging markets did especially well last year, and especially since in the latter half of the year, the emerging markets did quite well. And so what are we seeing year to date? Well, the trend continues. The S&P 500 is about flat, and all of these other markets, and especially the emerging markets, and now Japan as well, are doing much, much better. And so this is a good advertisement for international diversification, especially now, because I think the world is basically thinking that these tariffs are going to affect the U.S. more than they will the tariff partners, so to speak. The other thing we saw last year was gold. So gold and silver, commodities in general, did very well. The orange line at the top is silver. The blue line is gold. Silver is basically gold on steroids as far as investment returns. It's like leveraging your gold bet. They're pretty well correlated assets, but silver is much more volatile. It was up about almost 140% last year in 2020, or over the last year. Gold was up only about 75%, so gold has been doing well, and the gold mining companies have also done well over the last year and a half. Although gold has been doing well for much longer than that. Actually, it's been doing well for a number of years. And on the flip side, is crypto. Some people hold crypto. We've never invested in it, frankly. I don't invest in anything I don't understand. But Bitcoin was down about 30%, and Solana, which is kind of like Bitcoin on steroids, was down over 50%, and most of those losses came in October. So October was when we saw this real change in with commodities going up and crypto going down. So those are kind of what alternatives did last year, and going into this year, gold isn't going up as quickly, but it did pretty well over the first month in January. Now it's kind of flattened a little bit. It's taken a bit of a breather, and so that's what we're seeing right now. So it's always nice to have some diversification in the portfolio from alternative assets. Although crypto, I would say, is not for the faint-hearted. And so, what are the forecasts for the year going forward? What do we think is going to happen? Well, here's what Wall Street thinks is going to happen. Basically, Wall Street analysts expect to have a decent year. So they're talking mostly about the U.S. stock market here, although non-U.S. markets as well. And so what they're saying is they expect the S&P 500 to be up about 10%, which is an average year for the S&P 500. The long-term return for the U.S. stock market is about 10%. So that's an average year. Interestingly, the analysts are saying that equities outside the U.S. are also expected to go up, but less strongly. They expect euro to be up about 6%. Well, I'm not sure I necessarily agree with that. I actually think non-U.S. markets might outperform, and especially emerging markets, because I just see this rotation to people and investors putting more money outside the U.S. these days for a number of reasons. For one thing, the non-U.S. markets are a lot cheaper than the U.S. markets. Also, investors are worried about an AI bubble, and the U.S. market is about 35% technology, whereas if you look at European markets, there's very little technology component there. In the British market, the U.K. market is practically zero technology. So outside the U.S., the major markets are more bank-oriented, more utility-oriented. In some places, like maybe Australia, there are mining companies. In South Africa, I mean, certainly there are places like South Korea where Samsung is the dominant company there, so you have a technology focus as well. But by and large, what drives the U.S. stock market are the tech stocks, the Magnificent Seven, as they're called, and they've gone up a lot. I don't think that they're going to have those kinds of returns this year, and so really, I think it's good to have some international diversification, and our portfolios are probably 50% or maybe even more on the non-U.S. side these days. Now, the other thing we can look at is the economic side of it, and we have these indicators called leading economic indicators and coincident economic indicators. And so the leading economic indicator for the U.S. is a composite of about 12 economic things. So, for example, unemployment data. The stock market is as well one of the leading economic indicators that goes into this composite index. And so the leading economic indicator in this chart is the blue line, and the coincident indicator, which is supposed to measure conditions as they are now, is the black line. The leading indicator is supposed to foresee maybe 6 months down the road or something like that. So you can see a trend here. The gray areas are recessions, and you can see how the leading economic indicator goes down, and then eventually the coincident indicator turns when we get into a recession. And we saw that in 2000 with the dot-com bust, in 2008 with the real estate thing, a little blip in 2020 with COVID there. And what we've been seeing since 22 is that the leading economic indicator has gone down, and it continues to go down, but we have not seen the coincident indicator turn yet. And so we're keeping our eye on that. It looks like it's starting to flatten a bit. So that is something to keep your eye on. And, it's the same in Europe. It's basically the same kind of deal. Leading indicator going down, coincident indicator still going up. So we're in this sort of area where we should be a little cautious because there are indications that somewhere down the road there could be a recession coming. But to be honest, as I listen to earnings calls from about 50 different companies every quarter, and so far the earnings calls have been good. Companies are still doing okay. You see people spending money. I think the baby boomer generation is driving a lot of this. You can see cruise line companies, travel companies doing well. You can see discretionary spending doing well. And and so for now, I don't think there's any reason to change our investment philosophy. I think it's better to be invested than not. I think generally we're in sort of average times, decent times, but we have to keep an eye on it because we do see these economic indicators sort of foreshadowing something that might come in the future and might be negative. So in summary, basically the analyst consensus is about a 10% rise in U.S. stocks. Nobody really knows what the effect of Trump policies will be. For one thing, they change all the time. So it's pretty hard to invest around that. But I would say that these policies are probably going to have a bigger effect on the US than outside the US. But that's not to say that other countries don't have problems. I mean, Europe, the economic growth is lower than it is in the US. The US has pretty good economic growth. China, for years, has been in the middle of a 2008 real estate type crisis. The only reason we don't hear more about that is because, well, I mean, their media is controlled and so are their statistics probably. So China's not doing that well either. So the US is doing okay. And then there are concerns, though, about U.S. technology companies. I mean, those stock prices have gone up a lot. It might be good to maybe take some profits there if you can. I would say that they can't keep going up forever, and now they're spending a lot on things like AI, and haven't seen the payback from that yet. But more concerning is just how expensive some of these technology companies are now, and especially compared to markets outside the U.S. So then, looking at the economic indicators, we should watch for negative changes in earnings going forward, although I haven't seen much of that yet, as I say, listening to earnings calls, but we should certainly be aware of that because these tariffs could have an effect at some point. Maybe it's just a delayed effect that we haven't seen come through yet. And in general, we might see a downturn maybe 6 months, a year down the road. So we should keep an eye on that. But for now, I think things are pretty stable. So in that kind of an environment, income investments become more attractive, and so it might be good to orient the portfolio maybe less from the growth side, more towards the income side these days. And then as we talked about currency diversification, in my view, a balanced approach is the best way to go rather than focusing on having all your money in euros or dollars or something. And so that's that's sort of my 2 cents worth and a summary of what other people think. And in terms of income investments, it doesn't have to be just bonds. It can be dividend-paying stocks, preferred shares, real estate investment trusts, what we call BDCs, business development corps. All of these have yields from 6 to 10%, and they can offer good diversification to a portfolio. And then just briefly talking about a few expat issues that we see. So some people have issues with using a local address on an investment account. You should look at Charles Schwab or Interactive Brokers. They are two U.S. custodians that are pretty good at dealing with expats, and in most parts of the world, they don't require a local address. That's what we use to hold our client accounts. Sometimes you get some bad advice. What works in the U.S. may not work outside the U.S., like, for example, doing a Roth conversion when you're in a lower tax brackets, but maybe the Roth account isn't recognized in your country of residency as a tax-deferred account. And then there are regulations that come into play and currency conversions, so it's good to use a currency conversion company like Wise, for example, rather than going through your banks because you can get not very good conversions going through banks. We already talked about investing in non-U.S. currency. For local investments, if you're a U.S. citizen, we suggest keeping your investment dollars in the U.S. But if you want to have something outside the U.S., say in euros, then stick to cash products, term deposits, high-yield savings accounts, because you don't want to get into this PFIC situation. You don't want to be buying non-U.S. funds that are PFICs and will cause a U.S. tax reporting issue for you. Also, things like mutual funds, U.S. mutual funds aren't available to non-U.S. residents, and muni bonds aren't very useful because you buy them in the U.S. for the tax benefits, but you don't necessarily get those tax benefits if you're outside the U.S. So probably better to have taxable bonds and get a higher interest rate there. So those are some of the expat issues, and if you want to discuss these in greater depth, then feel free to reach out to me. But now I'll pass it back on to Hugo.
Thank you, Tom. Excellent presentation. So Natalie, should we head over to talk about some
Yeah,
taxes?
let's go. Let me share my slides then. Okay, you can see my screen? Yep, perfect. So let's talk about US taxes. I fear US taxes are not as interesting as investing, right? Because I think investing is always kind of like the fun side of personal finance. Now, taxes is not necessarily the fun side, but it is the side you have to deal with. So, as we're talking about being an expat, and as Hugo said, I get it. I am living in Austria now for 10 years. I used to be, where Tom was in California, and it can be a little tough because you have to manage your finances locally, and then you also need to manage your finances in the US. So, what we'll talk about is, what you need to know for this upcoming tax year, just generally tax savings, things that are kind of more good news. And then, of course, we'll talk about, well, why do you even have to file a US tax return? What happens if you don't file your US tax return and you need to get caught up? And then, of course, attached to your US tax return, what about this whole FBAR and FATCA, issues that we all have to deal with? So the first thing to start with is just, we're obviously in February. When do you have to file your US tax return? So if you are living in the US, I'm sure you know the date. It's April 15th. That's the date that payments are due and the date that you would have to file a tax return if you were living in the US. Now, as an expat, it is a little bit different. If you are not in the US on April 15th, you can actually delay your filing for 2 months. That's an automatic extension, but don't fall for it being very automatic because you actually do have to use an expat focused tax software or some type of expat focused tax firm. Just because if you file a tax return without the statement included saying that you are an expat, I mean, the IRS won't know that you qualify for this 2 month extension. So basically, just remember if you're an expat, you can't necessarily use the US based tax softwares because there are things you have to pretty much identify in your tax return to let the IRS know that you're an expat and you're eligible for, some additional benefits. Now, it's a little chicken and egg situation because even if you can wait until June 15th to file your US tax return, if you do owe taxes, you have to pay those taxes by April 15th. Because if you don't, there are interest and penalties. Of course, you could wait, but nobody wants to pay more than they have to. So if you do think that you owe taxes, we always recommend still file by April 15th or at least go into myexpattaxes.com and look to file your US tax return or at least model your US tax return so that you know if you might owe or if you can wait a little bit longer to file your US tax return. Now, of course, if you say, hey, by June, I can't make that deadline, I'm still waiting for my local tax return, because that is an issue. You're waiting for your local tax statements. Maybe you have a business abroad and it's just taking a little longer. You can file for an extension until October 15th. So you'd file this extension with Form 4868. And obviously, you could print out the form, you could fill it out, you could then snail mail it over to the US. We would not recommend that. It's a lot easier. You just go to myexpattaxes.com. You just, go ahead and file a free extension. It's electronic, automatic. You get a confirmation from us saying, hey, the IRS accepted it. And then it's easy. So obviously, if you need to file this extension, you do have to do it by the due date of your return. So you have to do it by June 15th. So it's not enough to ask for the extension, in September. You do have to do it in a timely manner. If you need more time, right, and this is really common for those that have, foreign limited liability corporations. So you set up a company in the UK, a limited, you set up a company in the Netherlands or in Singapore, etc. You probably do not have the financial statements you need to even file your US tax return. And so in this case, what you have to do is you have to send a letter to the IRS asking for an extension until December 15th. We do help you with this letter at MyExpatTaxes. And of course, we only recommend this for people that really need to wait because this letter is it's a hassle. You have to write a letter, you have to send a letter. The IRS doesn't tell you if you have the extension or not. They just tell you months later if they didn't accept the extension. So obviously, if you can stick to October 15th, we do recommend that. And if you haven't been filing your taxes yet, look to file them sooner than later, because in the event taxes are due, and again, for most expats, taxes are not really due. Right? You're filing a return, but most of the time you don't have any taxes due, but it can happen. So if you do end up owing taxes, then the sooner you file, the less penalties you have to deal with. So who needs to actually file a US tax return? So when we're looking at a US tax return, we're looking at, well, all US citizens and green card holders that pass the filing requirements. So when you look at the filing requirements, you have to look at, well, what is my worldwide income? Because it is not about just your US income, it's about your worldwide income, right? It's about what did you make in the US, what did you make in the UK, what did you make in, Japan, etc. Is it salaried income? Is it pension income? Is it rental income, interest income? You have to combine all of that. And then before any taxes or deductions, you have to look, do you meet the filing thresholds you see on the screen? Now, the filing thresholds are normally aligned to your standard deduction. And your standard deduction does increase every single year. I just want to call out that you probably see two very low numbers on the screen, and that's not a typo, because the US is very tricky and picky when it comes to people that are either married filing separately or self-employed. So if you're married filing separately, say you are married to a non-US citizen who does not want to be included on your US tax return, surprise, surprise, right? Then you don't really have a choice. You can't file as single, and you can't really file as married filing jointly because, they don't want to file jointly with you. So you're pretty much stuck with married filing separately. There is a tip: if you do have a US dependent, you may qualify for head of household. But most people that are married to US citizens will file as married filing separately. And that threshold has been as low as $5 since 2018. So even if just your bank interest went over $5, you have to file a US tax return, right? If you're getting some type of government benefits and that's over $5, you have to file a US tax return. So unfortunately, that's just the situation. If you're self-employed, so despite your filing status, right? If you are self-employed, even if it's not your main role, you do have to file a US tax return if your net self-employment income is over $400. And this is because the US is looking to see if you're subject to self-employment tax of 15.3%. So yes, there's two types of taxes to be aware of. There are income taxes, which we all know, right? Just normal income taxes. But there are things such as Social Security taxes, which is normally in the form of self-employment tax. So, a lot of things to cover in a US tax return. And basically, that's why it's probably easier to use a tax software or a firm that really knows kind of what you're going through. So, with that being said, let's jump into what are some good news, right? What's the good news? So, basically, every year, as I said, the standard deduction will increase. That's great because that means that you have more income that's potentially tax free. And since we're talking about investments and taxes, let me give you a nice little example. So, say that you make $100,000 in foreign wages equivalent, right? So, you have 100,000 US dollars equivalent in wages. And then, say you're investing in maybe US brokerages and you have $10,000 of capital gains for that year. Now, guess what? If you're filing your US tax return, maybe you could use the foreign earned income exclusion. You could exclude your foreign wages of 100,000 US dollars. And we'll get to it. There's a slide about it, right? But then that would mean that your only taxable income after the standard deduct or after the foreign earned income exclusion is just that $10,000 of capital gains. And then comes the standard deduction, no taxable income. So, it can be quite interesting as an expat sometimes to file a US tax return. There are a lot of ways to make it optimized for your situation, especially if you are still dealing with US investment income or things like that. So, I hope I piqued your interest a little bit because as I said, I know this part's kind of the tax part. So with that being said, tax brackets continue to increase, but rates stay the same. What does that mean for you? If you don't owe taxes and you never owe US taxes, it means nothing to you. If you do tend to owe US taxes because maybe you have a lot of US sourced income, that just means that more money is being taxed at a lower rate. So foreign earned income exclusion, I talked about it. This does increase as well year to year. And so this is a great benefit because if you are living abroad, you can exclude your foreign wages, as I said, and I'll get into the exact details soon, but this increased from $126,500 to $130,000 US dollars. So that's quite a lot of money you could exclude from your US tax return for being taxable. And then another benefit that people might not know about is the refundable child tax credit. It's called the additional child tax credit. Some years it's called the refundable, some years it's called the additional. It's the same. What it just means is that if you have children that are US citizens with a valid social security number under the age of 17, you might be eligible to get $1,700 as a refund for those children every single year, even if you don't pay a single dime of US tax, even if you're living abroad. That is a refund the US government will send you to wherever you live. So definitely, as I mentioned, filing a US tax return is not just paperwork necessarily. There are things you can do to optimize it, especially when it means, you have maybe US investment income, or you have children, or you're up for any other type of refunds. So a couple other things to note is if you are contributing to an IRA, and I know we touched on that a little bit earlier in the last presentation, the individual retirement accounts, you can contribute as an expat. And that contribution is $7,000, $8,000 for those over 50 for, the 2025 tax year. You can still contribute up to April 15th of this year. And of course, after that, you can just contribute to the next year's IRA. Now, just keep in mind, contributing to an individual retirement account, there are requirements to contribute. You can contribute as an expat, but you have to have taxable compensation. And depending if you contribute to a traditional or a Roth IRA, you might have to watch how much your income is because there can be limitations there. Now, if you're on the other side of that spectrum, maybe you're on the retirement end, not necessarily the investing end, right? Just keep in mind, if you do have an IRA, there are required minimum distributions. If you're not taking them out, you can be subject to additional tax. Now, please don't get too nervous about that. Maybe you missed a few required minimum distributions. All you have to do is ensure you file your tax return and say that you have a reasonable cause. You didn't know you had to take out that required minimum distribution. You state that reasonable cause, and you can, pretty, I won't say easily, but it's possible to get out of this tax. So if you do have required minimum distributions, remember them. Remember to look at that and talk to your financial advisors about that so that you can start pulling that money out. Obviously, a couple other things that are always in the news, IRS Direct Free File. They said they're going to make this great program for everyone to file their taxes for free. Us expats are still waiting for it, and I guess we'll still be waiting for it for a few years. We're always the last to kind of get these programs, but I guess we accept that at this point. And obviously, you probably heard it too, is the Trump accounts, right? So there are new IRA accounts that you could open. I mean, you're not opening them, but on your 2025 tax return, and you can do that with MyExpatTaxes, is you can make an election to open a Trump account for your children that are under the age of 18. There's still not a lot of information about Trump accounts yet, but they should technically function like traditional IRA accounts, except your children don't need to have, earned income or taxable compensation for you to contribute to them. So obviously that might be an attractive option if you're looking to create some type of investment accounts for your children. So expat tax benefits. I told you most expats don't owe taxes. And why is that the case? So that is generally because of these three different benefits. The first one being the foreign earned income exclusion, FEIE, Form 2555. I mean, if you search anything about expat taxes, you know about this benefit. And like I said, it's excluding up to $130,000 of foreign earned income from US taxation. There's a couple keywords in there. Foreign earned income. The income must be earned. So it's salary, self-employment, active partnership income. It's not a rental income. It's not investment income. It's not pension income. It is earned income. That earned income must be foreign sourced, which means you must have physically worked outside the US for this earned income. So if you worked for a US employer that said, hey, go take a year in Spain, we'll pay you with a W-2, we'll pay you to your US bank account, we'll pay you in USD. You worked the entire year in Spain for that income. Guess what? That is foreign earned income because you were physically outside the US when you earned that income. It does not matter that it was a US employer, a US bank, or USD currency. Now let's flip it on the other side. You worked for a German employer. Your German employer says, oh, you're a US citizen. You can go to the US without a visa because now it's almost impossible to get a visa for anyone to enter the US. Go ahead and spend a month there and work for us there. We'll still pay you in euros. It'll still be to your German bank account. Guess what? That 1 month you work there, your daily income, that's considered US sourced income now. So you cannot exclude that 1 month of working your income on the foreign earned income exclusion. Now, the foreign earned income exclusion is relatively easy to use this form, especially if you've lived abroad for over a year, but there are some cons. If you use the foreign earned income exclusion, you cannot claim the additional child tax credit, that refundable credit I told about you. It automatically, makes you ineligible for it. Also, if you want to contribute to an individual retirement account, it makes it really difficult because, again, my example, you have $100,000 in foreign wages. You exclude $100,000 in foreign wages with the foreign earned income exclusion. Well, guess what? Now you have zero taxable compensation. So you cannot technically contribute to an IRA. So that's why we actually prefer the foreign tax credit whenever it's possible. And obviously, this is for countries that have higher income taxes, because if you're living in a country with lower income taxes than in the US, the foreign tax credit approach is kind of useless to you. Or if you live in a country with no income tax, it's not going to be very useful. But if you can use the foreign tax credit approach, and that is something you don't have to, consider and weigh your options. If you use MyExpatTaxes, we actually model your return under both approaches, and we'll let you know, regardless of whichever plan you use, right? If you're in our do-it-yourself or you're in a premium plan, you'll always get in your tax return an optimization schedule to say, this is your return under the foreign earned income exclusion. This is your return under the foreign tax credit. We chose this approach because of X, Y, Z. Now, with that being said, foreign tax credit is great because you get carryovers. You can carry over 10 years of unused income tax credits, which is really nice because, say, you're a salaried person, you're paying a lot of income taxes in the UK, and then now you accumulate a lot of unused foreign tax credits, and then you retire, you take out a lump sum payment from your pension, which is not really taxed in the UK. Now, even though you don't have income taxes in that year, you have a whole bucket to carry over to use. So we do like it. It's pretty friendly. You can claim the additional child tax credit. So you still owe zero taxes, but you could actually get a refund. And then because you're not excluding any income from taxation, you have taxable compensation to potentially contribute to an IRA. It is complicated because there's a lot of different buckets on Form 1116, which is where you use the foreign tax credit approach on. So you'd have to figure out, is my income in the general bucket, in the passive bucket? I could go on and on, but there's no need for that. Basically, there's just a lot of, different conditions you have to meet, and you can't really transfer credits between buckets. And so it is really important that, again, we're using either a tax software or a tax firm that really understands how that works, just because the sourcing and the different categorization of income taxes is critical in computing the foreign tax credit. Now, the third benefit is tax treaties. We all know that there are tax treaties, and what we may not know is most tax treaties are kind of useless. And why is that? Because you see a tax treaty with, I don't know, let's say France. And it's really long, and it tells you how you should tax capital gains and interest income. And you're like, wow, this is great because it's like spelling it out for me. However, every single tax treaty has a savings clause. And the savings clause basically says if you're a US citizen, and some of them are even stricter, where they say if you had a US green card for like the last 10 years or something like that, you can't use 99% of this tax treaty. You can use 1%. There's like one paragraph that says like, except for these 3 sentences in this tax treaty, everything else is subject to the savings clause. So the tax treaty is great for income specifically Social Security benefits or government funded Social Security benefits, like pension income in that regard, because that you can't exclude with the foreign earned income exclusion. And then maybe, for social funded benefits, normally pay local income taxes on it. So that's where the tax treaty comes into play. But other than that, it's a little useless sometimes. Now we jump into kind of, all right, say you're self-employed. So that was kind of the general filing a tax return and those different benefits. I do want to narrow in a little bit about people that are self-employed because I know generally have the most questions, right? Just keep in mind, if you are a digital nomad, so you are someone that is kind of hopping around, if you are self-employed and you're not a salaried person, you're probably using the foreign earned income exclusion because you're not registered in any country. You don't have foreign income taxes to claim. However, because you are not, registered in any other other country and you're self-employed, you're probably subject to self-employment tax, which I mentioned is the Social Security tax. So this profile, even if you might be not subject to income taxes through the foreign earned income exclusion, do expect to pay 15.3% of your self-employment net profit as Social Security self-employment taxes on your US tax return. So this profile, please file by April 15th. You probably owe US taxes. Now, the next profile, if you're self-employed and you're a freelancer and you're just living in the UK, you're just living in Germany, you're just living in Austria, in France, in Japan, in South Korea, you're a freelancer there, you're registered as a freelancer, you report your income locally, you pay your taxes. You can claim the foreign earned income exclusion or the foreign tax credit, whichever one works best for you. You'll probably end up paying 0 taxes. On top of that, you can claim another type of treaty. It's not a tax treaty, it's called a totalization treaty. There's less totalization treaties than there are tax treaties, but this would effectively say if you are registered as a self-employed person in a different country that there is a totalization treaty, you can say, I'm only going to pay self-employment taxes and Social Security taxes to the country that I'm currently living in and I reside in. So that could mean that you owe 0 taxes to the US because you get an exemption on the self-employment tax. Now, totalization treaties are also, again, a little complicated. There's less of them. They pretty much cover, I would say, the majority of the EU and the UK. There's only a few really in South America and in Asia. So like in Asia, you have Japan and South Korea. I think that's generally it. In South America, I think Chile is a country that has a totalization treaty, but there's not that many outside of the EU necessarily. For example, New Zealand doesn't have one, and that is kind of a shocker because Australia has one. And so if you don't have a totalization treaty, please file by April 15th because again, you might owe taxes, 15.3%. Yeah, the other one is if you're a business owner. And that's also where complexity really gets there with a US tax return. Because that's the thing is you go and you set up a business abroad because you live there and that's just the way your career went. And then you get hit with you have to file all these different foreign corporate forms for 71 or 8865 and the list goes on. I just want to let you know, hey, MyExpatTaxes, we can support you with that, right? It is something that if you just search on the internet, it's generally very scary. And there's all these things about guilty taxation and thousands of dollars you have to pay for tax preparation. It is more complex, but it's not overly complex. You will use foreign earned income exclusion or foreign tax credit on your salary. You could use foreign tax credit on your dividend compensation, right? You're generally not seen as a self-employed person filing Schedule C because you're a business owner, you're paying yourself a salary for the most part. You do have to file 5471 if you have a foreign corporation with limited liability. If it's owned over 50% by US citizens, it is potentially subject to guilty taxation, which is basically your net profit of the company taxed at ordinary income tax rates. However, there are ways to lower that or exempt it altogether with the guilty high tax exclusion or the Section 962 election. So basically, yes, more complex, but it's not the end of the world, right? And I do want to mention too, I know we touched a little bit about PFIFs as well. It's not on this slide, but this also goes into this complex tax return. So if you own, if you didn't watch out and then you own foreign mutual funds, foreign pooled funds, and now you're in this PFIF problem, yes, there are more forms to file, 8621, right? However, it's not so overly complex. Normally, it's a bit of a shock because you have to file this form per fund. And so if you have a lot of funds, it can be very expensive for the tax filing procedure. However, if you only have 1 or 2 or 3 funds, it's very manageable. And, there is generally a good way to figure out how to lower that taxation. Obviously, if you can avoid it, you might want to avoid it. But if you're in there, I would say don't stress out too much, right? We can figure out a way to make sure that your return is as simple and optimized as possible. So I talked a lot about self-employment tax already. I just do a little brief on it because in case you're nervous about it, it is a Social Security and Medicare tax. It's about 15.3% of your net self-employment profit. And again, if there is a country with a totalization treaty, you can get an exemption from it. But if there is no totalization treaty, you are, stuck with the bill and you do have to pay that 15.3% of your net self-employment profit. That is why some people might create that foreign corporation so that they're not subject to this, and then they just have to file those different forms. However, it's not all bad because if you pay self-employment tax, you actually do contribute to your US Social Security benefits. So some people actually opt in to pay this, even though they don't have to, because if you pay enough and you're going to get a maximum of 4 credits per year, if you have 40 credits, guess what? The US will pay you Social Security benefits when you retire. So it's not all bad. It's just, technically paying now to get funds later, but I can understand you might not want to pay now, especially if you don't live there and you don't have much to do with the US. So another thing I do want to talk about is the child tax credit, right? We talked a bit about it in the beginning. There is a child tax credit. It is refundable. When we look at the child tax credit, there's 2 components to it. The first component is generally a non-refundable component. So if you are eligible for the child tax credit, it would help lower your US tax. However, if you don't need that credit, a portion of it is refundable. And so if it's refundable, what you would need to do to get that refund, because I know most people are thinking, well, how do I get a refund if I'm due a refund, right? Is you do have to have more than $2,500 of earned income. Earned income means worldwide wages, so US wages, foreign wages. It does not mean foreign self-employment income. It means US self-employment income, that counts, but foreign self-employment income might not count because if you do use a totalization treaty to get out of self-employment tax, then you cannot use the foreign self-employment income for your earned income calculation. So if you have earned income of over $2,500, you would just minus that by $2,500, you would times it by 15%, and then you have a refundable credit of up to $1,700 per child that is eligible on your return. Obviously, there are some income limitations. So if you're a higher earner, right, if you have over $200 in modified adjusted gross income for any filing status outside of filing jointly, then that refundable amount may be phased out. So a lot about taxes, right? I hope I still have your attention because there is one more part we have to think about. And it's not just about your income tax return, but it's about all the other forms you have to file along with your income tax return. So that is to do with FATCA. And that is also probably one of the reasons why it's really difficult if you are trying to invest to just, open up a bank account or your investment account in Europe. You might get hit with, we don't support US citizens. There's a lot to do with that. Obviously, as we mentioned, there are regulations about what funds you can hold, and I'm not going to touch that. However, there's also this Foreign Account Tax Compliance Act, and this is just making it really difficult for foreign institutions because basically they have to report any of their US clients' information to the US. And you also have to do that as a US citizen. So that is why you probably had to, when you opened a bank account, maybe in France, you had to sign a lot of different papers, tell the French bank about your social security number, which you probably thought was very irrelevant in France, but this is the reason. So if you have over a combined maximum balance of all your foreign financial accounts, bank accounts, investment accounts, pension accounts with a cash value, life insurance policies with cash value, if that's over $10,000 at any point in the year, you have to report all of your accounts on the FBAR, even if certain accounts didn't go over the threshold. But if you meet the filing threshold for the combined maximum balance, you do have to report everything on the FBAR. That goes to the Financial Crimes Enforcement Network. That is electronically filed outside of your tax return, not included with your tax return. And then if you have even more in combined maximum balances, you have to also file Form 8938, the FATCA form. And that is basically the FBAR plus like 5 additional questions each on your tax return. So that is included in your tax return. It's saying the same information. I do want to say there's no additional tax calculated on the amounts in your bank accounts. Your income is taxed, but just your money in your bank accounts is not necessarily taxed. So this is purely informational. So nothing to get stressed about, oh, I had too much in my foreign bank accounts, the IRS is going to tax me. It's about the income you have. It's not about the cash you have in your bank accounts. So just, this is purely informational. It's annoying, but it's not giving you additional tax. Do keep in mind there are penalties for not filing. So that's the one instance where it could end up in, some fees to pay. If you listen to me and you're thinking, okay, I haven't filed, I need to file, I'm in big trouble, you're not. There is an IRS program for expats specifically. If you haven't filed, it's an amnesty procedure. It's called streamlining. You'll see those acronyms all over the internet if you just have a look. And all you have to do, even if you haven't filed for 10, 30 years, is just your 3 back years of taxes, just your 6 back years of FBARs. That is the streamlining package. And then obviously you want to do your current year too, right, to be in good standing. And then you're tax compliant. And just remember this, if you were due a refund, because people were due refunds, maybe because of your children or you had federal withheld taxes that shouldn't have been withheld, you'll get those refunds. And then on top of that, it's funny because if you pay, well, it's not funny if you pay them interest, but if you owe the IRS and you pay them late, you owe them interest. If you file a tax return late, and you were supposed to get a refund on that tax return, even though you filed late, they will pay you interest on top of your refund. So, don't lose out on that. That is the streamlined procedure. That is something we also support. But again, if you're thinking there saying, oh, I didn't file, or maybe you did file, but you forgot certain forms for your foreign corporation, for your foreign mutual funds, for your foreign trust, or maybe you just didn't file the FBARs, there are ways to use this procedure to amend prior tax returns as well to ensure that you're not hit with any late filing penalties, because this basically waives all late filing penalties. If you owe interest, that still counts, but all other penalties would be waived. So I hope you enjoyed that, session, and we'll go back to Hugo now.
Nathalie, thanks so much. Excellent presentation on taxes for expats. So let's dive into some questions. I know lots of you have sent in questions when you registered for this webinar, and there are quite a lot of questions. We'll see how many we can get through in the time we have. Some of them are quite similar, so I'll try and pick some that are hopefully most relevant for quite a few people rather than too personal, and see what we can get through. And if we don't have a chance to answer your question, get in touch directly with Nathalie and MyExpatTaxes, and you can email them at team@myexpattaxes.com, and you can contact Tom via iamadvisors.com. That's iamadvisors.com. So let's dig into a few and see what we can get through. So there's one quite an interesting one. An expat in Poland who's been unable to open an investment account because they're a US citizen, an investment account in Poland. And they're asking, is this due to bank rules? Is there an international treaty that prevents them from doing it? And if they're able to have a regular bank account, why not an investment account? And what are their options?
Well, I guess this one's for me. So, yeah, a lot of it has to do with this FATCA reporting, right? So I imagine there's a FATCA treaty with Poland, and And so the financial institutions in Poland would have to report to the Treasury Department, to the U.S. tax authorities on accounts held by U.S. citizens there. And this is generally more burdensome for brokerages than it is for banks. And so that's probably why. Also, in the brokerage world, we have what are called know your client rules, and those sometimes come into play. And it's the same reason why some of the US brokerage firms don't want to deal with Americans living abroad, because there are different know your client rules in these other countries. And so that could be another reason. But you do have some options, and I see a lot of other questions, so maybe you can kind of summarize them on where you can hold accounts if you're an expat. So in general, Charles Schwab and Interactive Brokers are pretty good. Those are the two firms we use. Interactive Brokers will deal with Americans living just about anywhere. And if you live in Europe and you open an individual or joint account with Interactive Brokers, it's actually held in Ireland. Or I believe it could also be Luxembourg, but for our purposes, they're in Ireland, so they're Irish accounts. But Charles Schwab is pretty good, but they don't deal with every country. They don't deal with Italy, for example, or South Africa, or Philippines, or New Zealand, but most other countries.
Thank you. So, a tax question. As an expat receiving a foreign pension, how would that be reported or taxed by the US?
So it will depend what type of pension that is. We're generally looking at, is it Social Security funded, right, government funded, or is it maybe company or private pension? So if it is Social Security funded, then you pretty much look at a tax treaty first, right? So you look at a tax treaty because most tax treaties will say if it's Social Security funded, then only one country can tax it, either the US or the resident country. So it will say like the paying country has taxing rights or the resident country will have taxing rights. Now, this is generally always exempt from the savings clause, which means you can actually use it as a US citizen. Now, if it's not that, then basically you can't use the tax treaty, because even though in the tax treaty you would see a section about, employment pensions, that is not exempt from the savings clause. So for every other type of pension, you normally would just tax it fully on your U.S. tax return, and then in any income taxes you paid in your local country, you can then use to offset against it. And again, this is why foreign tax credit approach might be very useful, because pension will normally fall into the general bucket, which is also the same bucket as salary. So if you're looking to retire and you see that you're about to get a big pension payment and maybe not a lot of income taxes you'll pay at that time locally, it's really recommended that you're kind of piling up your foreign tax credits from your salary, which is generally taxed very high, so that you can then use that later on your pension income, because it's the same bucket on 1116.
Thank you. So I think the question of PFIX comes up a lot in quite a few of the questions. And maybe, Tom, briefly to just explain what PFIX are and why they can be an issue for expats investing. And then maybe, Nathalie, you can comment on the tax side as well.
Sure. So, PFIC stands for Passive Foreign Investment Corp. And already anything that's long is going to be a tax problem for you. So there you go. But basically what qualifies as a PFIC is for investment purposes, at least, and there are other things that are PFICs too, but for investment purposes, a non-US mutual fund and most non-US exchange traded funds would probably be PFICs. So because they're considered corporations, they're passive in the sense that it's an operating business for you, and so they're PFICs. And so that's what they are. So if you have investment dollars outside the U.S., what's not a PFIC? Well, what's not a PFIC is generally a cash product, something like money in a savings account that's earning interest, or a term deposit, or a high yield savings account, or if you can find some kind of a CD equivalent, or individual stocks and bonds are also not PFICs. So those things you can buy without triggering, like you can buy foreign investments without triggering the PFIC rules.
Okay, on the tax side, so when we're looking at a PFIC, it is taxed differently. So if you invested in normal, U.S. mutual funds, ETF, you would report like dividends and capital gains on your U.S. tax return directly. Now, the problem with the PFIC is every single fund you have to report on 8621. And then if you don't make an election at the time of purchase, it falls into this kind of default taxation scheme, which is under section 1291. Not that that's probably interesting to you. That just means it's taxed at the highest tax rate possible, which is about 37% at this point. And then that means any access distribution is generally taxed there, and there's potentially more interest. So I think what you get from what I'm saying is it can be taxed very unfairly, so to say. And so it's might not feel worth it to even have that investment product, right? It might wipe out any gains you have. With that being said, PFIFs aren't all bad. If you plan, it can be okay. So, like I mentioned, there are elections you can make, and there's also things called qualifying electing funds. So, for example, in Canada, because obviously there's a lot of Americans there, there's actually a lot of funds that get a PFIF statement created for them, which means you can elect them as a qualifying electing fund so that you have more similar US taxation on capital gains and dividends and distributions. That's not available for everything, but what is available for everything can be a mark-to-market election, mark-to-market, and that just means that at the time of purchase, you basically check a box on 8621 saying that every single year I'm going to tax the unrealized gains. And so basically every single year you would say, okay, how much did it appreciate? Or did it lower in value? And then that would be taxed at ordinary income tax rates. That's generally good for funds that don't obviously jump up and down, are very volatile, because you probably don't have so much that's being taxed, and that usually gets covered by your standard deduction. So you actually don't effectively see a PFIF tax out of there. I think the main moral of the story is if you have a lot of foreign mutual funds, like you're holding 10, 20, because maybe you use a robo-advisor or you use some type of financial advisor that has no clue and just puts you in a bunch of different funds, it's going to be a nasty surprise on your US tax return because the preparation fees itself will be tough. We offer very low PFIF preparation fees. Not everyone does that, but still they stack up because, again, it's every single fund needs that form. And then on top of that, if you do have PFIF taxation, then it's per fund, right? So I always say if you're going to do it, that's fine, but pick 1, 2, 3 funds, right? Easy to manage, easy to handle. Do not go and invest in 30 funds because that, just the preparation costs will wipe out your gains, right? It's just not even worth it at that point. But obviously, that's something you just have to weigh, right? Is the investments you're getting outside the US worth it for all the US tax hassle? Because obviously, we have US investments. I mean, the US understands them, so they're not making you file all these additional forms.
Thank you. So, one for Tom, I think. There's a question on retirement planning. So, I'm a dual citizen living and working with my US citizen husband in Germany. How should they plan for retirement and save and plan if they're an expat? And I guess there are two scenarios. We don't know if they'll move back to the States later or stay in Germany perhaps or somewhere else. So what's a good approach for retirement planning for Americans working abroad?
Yeah, it's a bit of a tough question. Let me just actually say one more thing about these PFICs because PFICs also work in reverse. Because, for example, in the UK, you have this concept of reporting and non-reporting funds. And so the US funds you hold may be the equivalent of PFICs in your country of residency. So you need to be aware of that. I mean, that's in the UK, it's in Austria, it's in other places as well. So you should also be aware of that. But yeah, the retirement question. So, in the US, we're used to things like 401k plans and all kinds of retirement vehicles, IRAs, Roths, and so on. And some of these you could possibly still access as an expat, depending if you have taxable income, depending on what your income level is and so on, how much you exclude under the foreign earned income exclusion. But it's probably going to be a lot less than you could exclude in, say, a 401k plan in the US. And so there's nothing wrong, if you can, on getting into the local pension system. Like in Europe, they have sort of a 3-pillar system where you have public pensions, private pensions, and your own savings, essentially. So most companies will offer some kind of a pension plan, pension scheme. And there's no harm in getting into that. If you're there for a number of years, especially, you can just treat it as effectively like a retirement account. At some point, you'll be able to access it. No harm in doing that. and that would be one choice. Otherwise, your options are kind of limited. You may be able to contribute to IRAs if you don't exclude all your income. And then you just have to do a savings plan into a regular bank or brokerage account. And if you want to, don't forget you can have you can have tax deferral in a regular brokerage account too, because if you buy something and you don't pay the capital gains tax until you sell it, right? So that's a form of tax deferral as well if you have sort of a buy and hold philosophy on your investments.
Thank you. So and actually some of these were covered in the presentations as well, but here's one. If one spouse is an American citizen, the other is a non-US citizen, but both are collecting US Social Security, how does that work for tax filing? Social Security is the non-resident, non-citizen spouse's only US income. So I suppose it's about what's the taxation of US Social Security, both of you?
So it depends if you have any other income. I mean, if the non-US citizen only has US Social Security benefits, depending on the country they're in, it might not even be taxed, right? So it might even be eligible for no taxation on that. Whether or not they have to file a US tax return is really depends kind of on the country, what treaties at play, things like that. If you are married, you could opt to file jointly, right? If the US citizen has a filing requirement and they might owe tax, it might make sense to just file jointly because you can elect to have a non-US citizen spouse file with you, right? You would have to go and file a return as a joint return. You would then submit that return paper mail to get an ITIN application. They would then get the ITIN, afterwards, after the fact, and then filing jointly might actually improve the tax situation for both if either or were subject to taxes on their income. But if the U.S. citizen spouse only has Social Security benefits from the U.S. and the non-U.S. citizen spouse only has Social Security benefits from the U.S., maybe they don't need to file a tax return, depending on if they have any other income or really what country they're in because of that tax treaty.
Thank you. So maybe just a couple of last questions. Tom, one for you. Somebody says, is it best to move investments with a US financial brokerage to a brokerage in Canada where I live when I move abroad? And I guess maybe that could apply to any country as well.
Yeah, we actually don't deal with people in Canada. Canada is one of the few places in the world where if the client lives in Canada, the advisor has to be licensed in Canada. And we're not licensed in Canada, but I am Canadian. And so the question is, I guess, broadly, moving your assets to the other country. Well, there's certain things you're not going to be able to move, like U.S. retirement accounts. Those are going to have to be U.S. accounts. If you have a U.S. trust, a grantor trust or something like that, then that's probably going to have to be a U.S. account as well. But if it's like a regular investment account, brokerage account, sure, you could move that to the other country. I mean, in some cases, you may have to cash out the investments. You may have to transfer cash, and so then there might be some capital gains to consider and so on. But then again, what are you going to invest in? If you're a U.S. citizen, beware of the PFIC rules, right? Now you've got a brokerage firm in that other country. You don't want to be investing, maybe if you want to avoid the PFIC rules, you don't want to be buying non-US mutual funds, for example. And in many parts of the world, investments are still very much mutual fund based. So beware what you're investing in if you're going to do that. But yeah, in principle, it's possible.
And are there good reasons to or not particularly?
Well, I mean, I would say, the US is a very competitive marketplace. The fees tend to be lower in the US. So apart from and we have broad investment products, if you're dealing with an advisor and it's a managed account, they tend to be more local centric. So if you're in the UK, then they tend to invest more in the UK, even though the UK is really only 6% of the global market. So I would say for U.S. citizens, it's probably generally better to keep your investment dollars in the U.S. But if there's somebody you like in Canada, for example, and certainly it's a sophisticated marketplace there as well, and there might be some specific types of Canadian investments. You might even be able to contribute to some kind of a tax deferred account in Canada, like a RESP, and so on. Then there would certainly be benefits to that.
Thanks. And Nathalie, here's one for you. Later this year, stocks from my company will vest for the first time. It's not a US company. What are the tax reporting requirements and taxation
So
implications?
it's kind of similar to when, stocks of a US company invest. So when we're thinking about getting restricted stock units, right? We just call them that. It's generally, that's what they are. Is there's a couple of different events that happen. When they vest, that means that normally the vested amount is considered your compensation, your salary. So you would generally report that as such. So you would see that in your wages line on your 1040. Now, it's a little bit easy in the US because it's normally included in your W 2. That might not be the case locally. So if your payroll does not include the vested amount as your salary, you need to add that on top as basically additional compensation. Now, when you go to sell those stocks, that is a different taxable event, right? Because when you go to sell it, basically you would see, do you have a gain or loss against the vested amount? Because you're already taxing the vested amount, right? That's kind of this whole thing. You vest it, and then you see that normally when you vest stocks, that maybe half the stocks go away to cover taxes. So you would include the vested amount as salary, any of taxes that were paid normally by withholding stocks, but also income taxes against the compensation salary. Now, when you sell it, you have a cost basis, which is the vested amount. And so if there's any gain or loss against that cost basis, that would be reported as capital gains on A949 Schedule D.
Thank you. Well, I'm afraid that's all we've got time for today. Thanks very much to our panelists for the presentations and to all of you for joining us. If you still have questions or you'd like to find out more or discuss your situation, head over to expatfocus.com and under services in the top navigation, go to either US tax returns or US citizens financial planning. Thanks again, and we wish you a very pleasant rest of your day.